Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review a scenario with velocity banking of how we may be able to help someone who's a doctor, a high income earner who's close to living paycheck to paycheck. Now, if you have no idea what velocity banking is, go ahead and click the link down below to Velocity Banking 101, get a firm foundation with the concepts about, and then come back to this video right here to continue your studies. Now, I happen to run to this article here called Here's Why So Many Doctors Are Broke. And from, I guess this is a website or a blog, Financial Success MD. And this was written really recently, like 2 years ago. It's this decade, right? And it says right here, most people think doctors are wealthy, even doctors do. So why do they have this perception? Because they make a lot of money, top 5%. Wow, I didn't know they're top 5%. Very smart, hardworking, and resilient. So one would hope that those would be a combination for a path to success, but not always. And I have a lot of doctors in the family, and I think they're doing okay. So hopefully they're not in this situation. But let me show you why it's really easy to be in such a situation, right? So think about this. Let's say you had a salary of $20,000, and you might be thinking, well, that's not a doctor's salary. Yeah, I already know that. But add that $20,000 salary, you got $60,000 of debt, which included, maybe educational and possibly really cheap, I don't know, housing expenses or something like that. You got a property really cheap. Now you might thinking, well, if I make $20,000 and, based on all my debt, I have $60,000, that's insane. Like I would just not even go to college or whatever, or get a student loan and just go work at McDonald's because I'll probably do a lot better at full-time McDonald's than in this situation. And it's totally easy to see at a lower income why no one would really get into this situation or shouldn't get into this situation, right? Now that we've done that, so let's just, or now that we've gone over that, let's just go ahead and review the situation that a doctor might be in. So let's just add an extra zero, right? And add an extra zero. So now this is a salary of a doctor and some debts that the doctor might be able to get it to really easy. Let's say student loan, right? So that's 200K student loan plus maybe you have a $400,000 home loan, right? So now you can really see, oh wow, like I could totally see like if I were poor, I wouldn't, get into debt that's 3 times my income. But as a doctor, oh yeah, that's kind of socially acceptable. Why would I ever do that? You see what I'm saying? So now you can see like how easy it is to get into um, debt and be near paycheck to paycheck when you're a doctor, right? All right, so now let's go through this as a velocity banking exercise. So I'm going to go in here. And first step, I always say, okay, when you do velocity banking, you always make sure, first step, always have a budget, right? So we have our budget, and we have two budgets actually. One is the average American doctor. We use the term average American to mean that you're using your checking account as your main operating account and doing things the average standard way. So I grabbed some figures here from Google and I think ChatGPT. So let's just assume that our paycheck's around $205,000, and we make about 11 grand in income. Now these expenses, they're kind of big, right? 9,000, about $10,000, and we only have 1,200 in savings. So, when you're a higher income earner and you only have that little in savings, it almost kind of feels like paycheck to paycheck, right? And then after that, we have our expense breakdown, right? So we break down our expenses, and what's really important when we do our expense breakdown is making sure that every single debt that we have is its own line item. And the reason is because every debt that we eliminate is going to be cash flow that's recovered, and that's really the main goal of velocity banking. So we go down here. We have a credit card, BMW, student loan, mortgage, and I kind of did some further calculations here. So the student loan is originally started at 200, but they're like 1 year in, and same with the mortgage, it was like 500 and 1 year in. And if you sum up the debt, the total debt is $750,000 for someone making $200,000. So, you're gonna kind of sweat a little bit here with this type of debt, but you can kind of easily see how easy it is to get in this type of debt. I mean, especially if you're a doctor and you graduate and you wanted that BMW, sure, why not? And why not just splurge a little bit? Go on trips, YOLO, right? So, okay. So now what we're going to do is we're going to go to step two, which is select our operating account, which is going to be a line of credit. So here we have our line of credit of $100,000, and you might say, well, first of all, what's a line of credit? Well, a line of credit is a financial tool where you can borrow money, pay it back, and then borrow money over and over again. So a credit card's a line of credit, right? There are different types of lines of credit. So you might be saying, where do I get a $100,000 credit card? Okay, so we have something called, since we own a home, we have something called equity. So equity is basically the estimated sales price of your home minus the amount that you owe, right, on the loan balances of the home. And let's just assume that for this person, the property value greatly appreciated, hot area. Now the equity is about $125,000, right? $125,000 equity. And usually banks will let you borrow about 80% of that in the form of a line of credit. Hence, they call it home equity line of credit. So now we got this sweet almost credit card. It's like a credit card based on your house that has $100,000 limit. And usually when you give up your home or anything, your possessions as collateral, they give you lower interest rates. So I've heard that people got interest rates as low as 4%. I've never gotten that. My home equity line of credit is around 10%. So we're going to use this as our main operating tool for velocity banking. And if you don't know the strategy, all you do is just put paycheck in here, take your expenses out, and then your cash flow is going to be the basis of lowering the balance on the credit limit. If you have no idea what I'm talking about, I'm going to just show you right here. So now we're going to do the velocity banking doctor's budget. So now we're going to do this. So 11250 expenses. Let's just hold off on that right now because we're going to break that down a little bit later. Savings, when we do velocity banking, we don't really have any savings because, again, paycheck goes in here, expenses come out, and we're going to use what is essentially would have been our savings, which we call cash flow, to bring down the debt on the credit limit. So now let's go take a look at the expenses here. So now one of the things that we can do to put some debt on the line of credit here is just move some of our debts to free up our cash flow. So here we have a credit card balance of $40,000, right? At 25% interest rate. If we just move this from here to here, we're going to totally save money just based on the interest rate alone, right? So just put it $40,000. Okay, we did that. Now this goes to zero. Bam, right? Zero. Okay. Now we have our next one. Our next debt that we have is a BMW. Now it's at a 5% interest rate. Now you can debate like, hey, why not just work on the credit card debt first and then work on the BMW afterwards? You totally could do that, right? But you know what? I just want to get rid of my car debt. It's totally okay. I free up $750 of cash flow. I'm okay with it. So let's move that to here to $70,000. Okay. And then I'm going to put that as zero. And then now our student loan debt is there. Our mortgage is still there. Our other food, gas, insurance is still there. So now let's go ahead and sum up our expenses. So from C7 to all the way to C11, that'll tell us how much our new expenses are. Sum C7, C11. Let's go ahead and do that. So $8,001 and then equals C2 minus C3, and that'll tell us our cash flow. So we have about $3,249 of cash flow. So it's a little bit better, in my opinion, to work this way just because you have more room to work with than the $1,200 of savings a month, right? I'd rather always work with more cash flow to work with in case of emergencies than doing it this way. But again, to each his own, right? All right, so now we got that. So what we're going to do is put our entire paycheck here. So our balance is eventually going to go down $11,000. Eventually, the expenses will creep up by $8,000, and then the balance itself at the end of the month will go down around $3,249. Okay. Okay. So now we got H2. To calculate the next month's balance, it's just the previous month's minus the cash flow. So 3,249, and it's just the estimate, right? So you don't have to worry about that. Just gonna copy and paste, and you don't have to be too exact, is what I want to say. So now we can see that we went from 70,000 to all the way to zero. So let's go ahead and figure out how many months it's going to take us. So I always like to call the first month zero. And then now what we do is we're just going to just apply this formula of the previous month plus 1, then copy and paste and figure out how many months is it going to take us to pay off the debt around, right? So about 21 months, which is a little bit under 2 years. So that's pretty good. And let's go ahead and calculate the interest because we have a 10% interest on that line of credit. And so now to approximate the interest, all you have to do is just take the previous month's balance. So that'll be H2, multiply it, multiply it by 10% and then divide it by 12, right? So 10% is the interest rate, but that's quoted annually. And if we want to get the monthly interest, we divide by 12. Now, if you want to be more exact, they actually calculate by the average daily balance, but we don't know when expenses will incur. And so we're just going to do only use the monthly balance because good enough is good enough, right? And so now we have all the interest calculated here, okay? And so now let's go ahead and sum it up. So let me go ahead and sum that up right there. So to sum it up, you just click this auto sum button right here. And we paid about $6,500 in interest, right? So a little bit less than, well, actually, if you add this here, probably around barely at the 2-year mark to pay off this debt. And we have to pay about 6,500 in interest. Now, what's funny is that even though this person makes a lot more money, in the other scenarios I always showed, the debt was paid off in 1 year, and it was a person who made a lot less money. So again, it's not, at a certain point, if you make a lot of money but you have a lot of expenses, your debts just don't pay off as quickly as someone who makes less money and almost, barely any expenses, right? So yeah, just keep that in mind. And you could compare these figures to the other videos that I've made, and I always use like the same $5,000 figures. But here you could see that the average doctor doesn't really pay off his debts quickly as like the lower income earner in the other videos. Okay, so now we got that. So let's just say 21 months. How many months is that? We'll just add. We'll just say. Well, I'll just say 2 years, just to be a little conservative. So 2 years, we had to pay about 6,500 interest, and then we paid off $70,000 in debt, right? So let me go ahead and record that. And again, these are all estimates. I'm probably overestimating how much we're paying in like interest and how long it's going to take, right? So now, okay, so now let me go ahead and erase this. So now that we've done that, now what we're going to do is take on either the student loan or the mortgage. And you can see that with the student loan, it's so big, and and so is the mortgage. And it's like, okay, how do we know which debt we're going to pay off? One easy way to kind of figure it out is use a formula called a cash flow index. So that's invented by a guy named Garrett Gunderson, Wealth Factory. Go ahead and Google it, cash flow index. But all it is formula where you just take the loan balance. So just say 185,000 divided by the monthly payment, 2,174, right? And same here, so equals 494,000 divided by 3,327, right? And basically, the way that the formula works is that you're going to use this formula in all your debts, and whatever's the lowest number, that's like the ones that you want to get rid of first. So since 85 is the lowest number, lower than 148, we want to get rid of this first, okay? Now, another thing to consider is that we only have $100,000 in the line of credit, and we have $185,000 of debt. And not only that, it's lower interest debt. So when we have lower interest debt that has a higher balance in our line of credit, we don't necessarily want to, let's say, they call it chunking, charge $100,000 into the line of credit. It's actually more efficient and to just kind of move it in pieces, like $25,000 or $30,000 or even 10, maybe something that's really more than your paycheck, maybe 15,000, then the entire thing. Because what's going to happen is that when you move the entire thing, if there's not enough cash flow to offset like the balance of the line of credit, it's going to for sure accrue more interest. And if you don't know what I mean by that, I kind of go over it in the Velocity Banking 102 video. and we're going to kind of go over it here, but we'll see how much we cover it. But my point is that when we attack the student loan, that's a lower interest debt, but at a higher balance, we don't have to use the line of credit. The line of credit is used to mainly for liquidity purposes and attacking the principal at the same time, make it easy for you to attack the student loan debt. So let me go here, and I have this what's it called? Mortgage amortization calculator. So here's the unrealistic part. The loan balance isn't going to be the same after 2 years at 185, right? It's not going to be the same. So, but let me just kind of put that here. So it's actually going to be a $200,000 balance, but we'll just say it starts at 185. That was the original, but who cares? So we'll just say at 185 is the balance at 30 years. And what was the interest rate? So the interest rate was at 5.54%. 5.54%. And we'll just say 10 years. And actually, let's just do this 2000. We'll get the original balance. And we have that monthly payment of 2174.49. And now we're pretty much 2 years in, right? So we were at the 185 balance right here. And then now we're going to be at 7/1/2026. 7/1/2026. Okay, so now what do we do here? So I'll just give you a quick visualization. Basically, we're going to transfer chunks from the line of credit to the debt, attack that student loan principal, and then rebuild, go back to zero by doing what we did, putting the paycheck here, go back over and over again, right? So if we put a $25,000 balance here, and we'll just do this, H2 minus 3,249, 23, and this is approximation, right? This isn't, okay. So within 0, 1, 2, 3, 4, 5, 6, 7, about 7 months, after every 7 months, then we're just going to apply another $25,000 in the principal. So it's like we're maintaining we're using our cash flow to deplete the line of credit, maintaining our liquidity, and attacking the principal and saving on interest at the same time. So let's just go here. So in the what's it called? Student loan amortization schedule, where wherever going to start, we're just going to put $25,000 here as a payment, 25,000. Okay, so let's just see how much money we save by doing it there. So we save $10,000 by doing it there. Again, you don't save as much money in a 10-year loan compared to like a 30-year mortgage. So, but we do save money. So $25,000 and then, or $10,000, and then every 7 months we chunk. So 1, 2, 3, 4, 5, 6, 7. Oh, did I do that right? Let me calculate it. So this is 0, 1, 2, 3, 4, 5, 6, 7, and then we'll put another $25,000 here, and then 1, 2, 3, 4, 5, 6, 7, and then we put another $25,000 here. 1, 2, 3, 4, 5, 6, 7, and then 1, 2, 3, 4, 5, 6, 7. And actually, we don't even have to put another chunk in the line of credit because the loan will have died by then, right? But at this point, the line of credit will have been replenished. We just make a few more payments, and then we're good. So a loan that was going to take us 10 years. Let's see how much it takes now. So this is going to be, we saved 33 minus 29. We saved about 4 years, right? So this was originally a 10-year loan. So 2023. So it took us about a little bit less than 6 months. So a little bit less than 6 months. How much is 52 months? Let me just calculate that. So 52 divided by 12. So that's 4.3 years total of what we paid in the student loan. So let me just kind of write that down. 4.3 years. And let me erase these cash flow index numbers. We don't need this for now. Let me go back here. And so we paid 38 we saved $22,000 and we paid about $38,000 in interest. So we did save some money. So let me put that here. So $38,000 in interest. Yeah, so we definitely did that. And we have to also include the interest from the line of credit, which we didn't do. So we can always add that at a later time. But for the student loan itself, we paid about $38,000 in interest in 6 years rather than the full 50. So we did save some, but not as much as if we do it with the 30-year mortgage. So now we've done that. So we took 2 years, we took 4.3 years here. Again, some of this I might be a little bit off just because I might be overlooking a few things. But now what I do is I put this at 0, right? Because we paid off this debt, these 3 debts in about 6.3 years. Now we have the mortgage, right? So now we have the mortgage, and now let's just put this in the mortgage calculator and see where we're at the amortization schedule. So we'll just do $500,000. And let me just do this too. Let me restore most of this and take away those chunk payments. Okay, so we got that covered. Yeah, so okay, so let me just do this. So 500,000 was the original loan. It's 30 years and 7%. So it should match that number that we have here. Yeah, 3327, 3326, almost the same thing. Okay, so now that we got that, 6.3 years will have passed. So let's go to the 6-year mark. So now that'll be 2029. And maybe, so that'll be a few months after 2029, but we'll just, so 2029. So we'll just say, what, December? No, good enough. I'm just estimating. Okay, so December 2029 will be our starting point for doing velocity banking. And now we just kind of repeat the same thing, right? So now what we're going to do is put a $25,000 chunk, and then now we're going to have our new cash flow, which is now at $5,423 because we paid off the student loan, to figure out how many months will it take for us to restore our line of credit. So what we do is we just take C3, oh, I'm sorry, the previous balance equals H2 minus 5423. So let's go ahead and do that. So as you can see here, it only takes us about 4 months to replenish this line of credit. 1, 2, 3, 4, which is really good, right? So now what we do is at this stage, we put $25,000 here, and then 1, 2, 3, 4, and then we'll put another $25,000. And then if we rinse and repeat, so let's see how much money we saved. We saved 145,000 just from doing those 2 little chunks, putting into the mortgage, right? And so here's the thing: I don't want to do this whole thing, but you can kind of get the process doing it over and over again. But I have a more accurate calculator that's available to our group members here, right? It's available to our group members, and it's provided by Renata. So we're independently affiliated with them, and we're what we call independent contracted marketers, but basically we're affiliates. We market their educational products and we get a commission out of it, full disclosure. And for anybody who joins our group, they're actually going to get this calculator, but we don't provide this for non-group members. So just be aware of that. Okay. And also, free tool provided as is no guarantee or warranty of accuracy. So it's possible that this is all BS and I'm just fibbing for the sake of fibbing. Okay, so now let's go back to here and here, because what we're going to do is we're going to put in the calculator these figures and let the calculator do its magic, right? So no need for us to manually do things. So what's the interest rate? The interest rate is 7, 30 years. The payment amount, let's get that payment amount, which is, let's be more accurate, 3326.51. 3326.51. Okay, So $25,000, 10% line of credit. I think I already inputted the income and expenses, but let me just take a look here. So the expenses, okay, actually I just need since it's actually 2,500, right? Because when you do use this calculator, you don't put your mortgage in there. So let me just redo this as 2,500. Okay. And so now you can see here that this is actually going to be paid off in 5.4 years. And the interest that we're going to pay is 94,000. Okay. So just how I showed you, we only pay $94,000 in interest compared to $483,000. And I think this is just based on the current balance, not actually the original balance. So it might be a little bit more. But basically, we didn't pay more than 100% interest on the loan. So you want to know why a doctor would go broke buying a house? Because at a 7% interest rate, and those are the only people who could buy homes at this year, because your average, first of all, 90% of people can't even get a mortgage, right? And then the ones who can are high income, good credit earners, but because they don't realize, oh, 7% loan is actually like more than 100% interest, they don't understand, oh, why they're going broke, right? So 5.4 years at $94,000 interest. So that's a lot more than I would like to pay. Oopsie. So let me I'll just put 94K, 94,000, 4,000 interest. And now we have 5.4 years. Okay, great. So now, after this, then this will essentially go to zero, right? And now we have a lot of cash flow, which since we have no debt, this would essentially go back to savings. So this would be 8,750, right? So this is money that that's going to stack up every month. That we can do anything we want, and we can put in our 401k. If we're just kind of conservative, just want to save money, be Dave Ramsey style, we do that as well. But that's way sweeter than being in this position where your savings is only like 1,200 a month, and you're a doctor. You know what I'm saying? And let's see how long it took us to get there. So we'll just sum it up. Let's just kind of do this. I don't think I can sum up numbers with text in Excel, or it might be a little bit harder. And again, this might be inaccurate just because I may have like omitted some things or skipped some months while doing this. So 5.4. So it's going to take us about 11.7 years to be debt free, right? It's not bad, but ideally, if we're making, $11,000 a month, um, hopefully we could just be debt free in 2 to 3 years. But because the expenses are so high, $185,000 student loan and $494,000 mortgage balance, it's going to take us 11 years, but it's better than being paycheck to paycheck for your entire life, like most people are. And hopefully you're not one of these doctors that's being described in this article, right? Because if I meet you and you're a doctor, I'm going to assume you're successful and you can pay to go in our program. You know what I'm saying? Like, there's a saying like, don't do business with broke people, because they're going to penny pinch you, and they have a different mentality than people who are rich. But that's another story. It's something I learned from a marketing class. Okay, so now, yeah. So basically, we saved a lot of money because, again, if we had paid this to 30-year term or we had refinanced, that's more than 100% interest on the loan, and we'd be paying like almost $1 million, or probably a little bit more on just the mortgage itself. Same thing with the student loan. I mean, the student loan, we're probably going to pay like $50,000 in interest, but we paid less. Instead of 10 years, it went to 4.3. These could have gone on forever. 70,000. That's a lot of debt, right? But we paid it off in 2 years, and so now we got rid of this $750,000 of debt in about 11 years. So that's a pretty good job. Although, like I said before, if I were a doctor, I'd hope that, I'd be blowing, swimming in cash flow, that, I could get rid of any debt in like 2 to 3 years. But this is I guess, a dream killer. Okay, so this is a Korean Atlanta mentorship. If you have any questions, comments, leave them below. If you're a broke doctor, hopefully you found this to be insightful. And if you're interested in joining our group, go ahead and click the link down below to the Google form, or you can, email us in the About section of the YouTube channel. Okay, have a great day, everybody, and we will speak next time.